Presentation with a cliche of opportunity, but I'd like to start it off with a story. A long, long time ago, my great-grandfather came all the way from India to Canada, and he did it taking a big risk, leaving everything that he knew from behind, and going into a new place and starting off. And that's exactly what you're doing. However, he had no experience, and you do. My name is Amit, and these are my colleagues, Nick and Adam. And we're going to talk to you a little bit about the opportunity ahead of you, and we'd like to help you with that. So our recommendation starts off with our primary issues, expanding into Japan, and our secondary issues, do we buy something existing, or do we take something that's starting on our own?
Starting a little bit about the country of Japan. Households. Households in Japan own about 1.5 trillion yen within assets in the Japanese market. The total demographic there, you have about 20 to 74-year-olds, which is like the greater majority of the population there, and that demographic makes up about 36.5 million. Which is about the target market that we want to approach, and about 38, concludes about 38.1% of 25s to 54-year-olds, and that's the older demographic. There is looking for more of a low-risk product such as the global bond, and then we want the younger demographic. We want to aim for more of the global equities fund. The risk aptitude there is very low, and we recommend marketing the Global Balance Fund, as I said, to the older demographic, and the Global Equities Fund to the younger demographic.
Talking a little bit more about the industry within Japan, the whole industry has about 415 trillion yen in assets under management within Japan. But with this huge market, there's only about 808 million yen of fee revenue per year. So we really think that your company, with its unique fee structure, can really shine within Japan. The opportunities are expanding. Since 2008, operating margins have jumped to 30% from 8 or 9% in the financial crisis. This is a huge opportunity for you to jump in and take advantage of. As well, there are a bunch of threats we have to go over. First and foremost, there's over 250 players currently in the market. It's extremely saturated, and it will be very tough to break out, but we believe that with our strategy and our recommendation, it is possible. As well, the current market in Japan is still quite uncertain due to their ongoing economic recession, but that's another threat that we will have to consider. So the key takeaway here is that you guys are a fresh face, and your fee structure will be an interesting take that could appeal to many consumers in this market.
So some of the strengths that you guys have is that international offices are all over the world. They're in major hubs. You're successful in your previous expansion campaigns, which is going to be a real strength to you as you move forward into Japan. The ownership is very experienced and knows what they're doing. Some of the weaknesses is that we don't have any representation in Japan. We have nobody who speaks the language right now. We don't even have anybody that we can link up to at this moment, which is something that's problematic, because as we go forward to achieve the proper accreditations and doing business there, we'll have to make sure that we acquire those skills. We also have our fee structure, which is a strength, but also can be a weakness for us, because as we move forward as the markets, if there's market turmoil, then you won't make as much money. So that's something that we'd have to consider.
So some of the key requirements that we're looking for as we enter this market is a strong market entry. That would come in with enough acceleration that we could already start doing operations, and something that's financially feasible, so nothing that's too expensive and we can get a good grasp on. So what are our options? Option number one, is to start in as a greenfield investment. The issue here is that there are some licensing issues, and it takes about 1 year to get the Type 1 GSDA license, and it gives the credential to operate within the country. Another issue is staffing concerns. Staff there have to work at least 3 years within the market in order to work within the asset management, within the finance industry. Another one is capital requirements. Obviously, that's going to be a big cost of entry. Yeah, so more of a little bit of the cost structure. We have about, just initial capital requirements would be about 500 million, and that could easily double. Then we have legal fees of 150,000. Sorry, that's 500,000. We have legal fees of 150,000. That would be to deal with any lawyers, accountants, in order to receive that license to operate within Japan. And renewal per year for that license is $1,500. Hiring talent, we thought we would do a third party to come in and hire staff, which would look for experienced staff, which have that 3-year experience. We've estimated that would be about 25,000, just an assumption. And that total comes to 676,000.
So just looking back at our criteria, our first option, start on your own. It's going to be tough to enter strong starting on your own because it is such a saturated market. It is extremely financially feasible though, as startup capital is going to be lower than $1 million just to get your foot in the door. And staffing concerns, or staffing requirements are also another large concern of this option. Our second option is to buy out an existing competitor. Now, the advantages of this is that you can retain the existing staff members and you get their street cred. You can buy them out and then, sorry. Option 2 would be to buy out a competitor. This way you'd be able to retain their staff members as well as have brand recognition within Japan. This is a big issue in Japan as there's been a lot of international companies such as Walmart that have really tried to come in and force their way in and have had no success. One notable exception is Toys R Us. However, they have much larger capital resources than you do at the moment. And I really believe that the best option here would be to buy out a competitor and gain that brand recognition. One option we have in mind is a company, Target Securities, and their current market value is about 111,000 Canadian. We believe that at about a 20% premium over market, we would have no problems buying them out at about $134,000. So again, this would allow us to have a strong entry into the market as they're already an established player. It's less financially feasible, but still incredibly cheap to buy the company, but the legal fees and the processing fees would add up. And the nice thing about this is that we would have some experience in the market with some Japanese staff members already on the ground.
So the recommendation that we're giving to you today would close a lot of distances. So culturally, we would be able to get someone who's speaking the language, who knows the way to do business there. That would be very advantageous to us because we don't have a presence there. We would also be able to close the administrative gap as well. We would be able to follow all the regulations and any kind of requirement needed by government. Geographically, obviously, we would be in the country and have a presence, which we didn't have prior. It would be a cheaper alternative. Also, one of the key things would be keeping key staff, and so that would give us that was one of your concerns. Is there going to be an ability to keep key staff, and that would be a great opportunity to do that. So step forwards, a bit of an implementation. You would buy the company right away, get into negotiations and buy the company with the the price we have recommended. Keeping the key staff would be the next step forward, making sure that you have the right people, and then the third step would be to integrate Orbis's values and a lot of the shared values that you want to have within the new company in Japan. So that would be a very key point as well.
So what's the timeline, if you were to buy out a company? So we estimate that within this first 6 months, it would be a lot of administrative duties, such as any legal issues dealing with the accountants, lawyers. And then once we're able to actually purchase the company, we would then go into the company and then evaluate certain key staff, see which one fits our values, see who would be the most valuable for that, and then market the products that we have. So as I mentioned earlier, we have the global bond product, which is a more safer investment and requires about 3 years within that mutual fund. And we would market that more, as I said earlier, to the older demographic within Japan who are looking for lower returns but lower risks. And then we would also then market the global equities fund, which is more like the 20-year-olds and looking for maybe just a medium risk with high returns. Then we estimate after a full year's time of the acquisition of the company, we would come to the full operations where we're able to get on our feet completely and move forward from there. Yeah, and Adam will talk more about the risk entailed with that.
So risk one, obviously in any buyout, the biggest risk is that your key staff leave. This is a big risk and one that you guys are going to, and one that we have to address moving forward. Our main recommendation here, if this happens, is to hire an outside party, similar to option one, to source some other talent from the area. We want to keep local talent because we really do believe that the Japanese market is unique, and it will lend itself well to our company. Second is market volatility. Obviously, if the markets go down, your fees go down as you have to refund the fees to your clients. This is another big issue. However, because the margins are so high currently in Japan, we believe that it will still be profitable to expand even in the face of market volatility. And the third risk is threats from competitors. This is another quite large risk, and the main way to combat this is going to be marketing and getting our product out to the people, really getting our face out there, showing everyone who we are. Because there are so many competitors, the only way for them to choose us is to show that we have a unique fee structure, that we are a Japanese company, and that we are quite profitable. And now Amit will finish us off, just quickly talking about our criteria again.
Okay, so when we were deciding on what alternative to take to recommend to you, just revisiting our criteria was a strong entry, it was financially feasible, and was the staffing concern that you had met. And we feel that the recommendation that we've given meets those criteria. We will enter into the market strongly because there will be a presence there with a company that's already established there, and it's going to be having the key people to meet the meet the licensing criteria. That's the Type 1 JSDA license that we need, that you will need, will be brought from. Will be able to be acquired because the staff. The company will have the right staff, because the regulators will only want to speak to people that speak Japanese and are key part of the company. So the key staff that we will keep will be the ones negotiating. The other criteria about the being financially feasible, it's not going to be a large investment. It'll be something that you can easily afford, and it'll give you an advantage once you've entered into the market. The staffing part was the last one, and we've spoken about that quite often. That's a really big part of licensing yourself, getting involved, being able to hit the ground running. If you don't have the key staff, then you won't be able to do that. And that's what we really are concerned about, is that you have the right people to get the right licensing, because that will make the timeline much, much quicker than the first alternative, which was to start off from scratch. That would then extend the timeline. So it would take a year just to get the licensing. Then it would take the time to hire the key people and to meet the requirements to have the license. They want to have those key staff in your company before they can start to negotiate. So it would be quite arduous, and we feel that having the alternative that we've recommended be much quicker, much more feasible, and it will give you a strong presence in a market that you don't have a presence in right now, and you'll be able to compete with the 250 other companies that you have right now that are established, that have been there for many, many years, and it will, to get get your company out there with a strong presence is really important. And so in summary, we say buy Target Securities, and for that we are now open to any questions. Yes, sir.
So I appreciate you highlighting the risk of key people leaving, and you propose the solution of hiring somebody externally to find replacements.
Right.
What are your thoughts on trying to keep them in the first place so they don't leave?
Well, that's a really important part of any corporation that's trying to enter into a new market, especially in this case because of the requirements from the regulator. To do that, what we'd like to do is first interview them, see which people align with our values and which people we can keep or that are closer to our values, and we can train those values into them or present those values into them. So that would be really important, and that would be a 6-month timeline, and would take your people to go there and do that, and that would save you more time than to having to try to start from scratch.
Yeah, we also hope that with those values as well, there's the value incentive within the actual model, so they'll be motivated to actually make returns for the customer, and as a result, they'll receive higher commission rates for making higher incentives for their own customers.
You talked about marketing the products. What would your recommended plan be, and the costs associated with marketing for a brand that's not recognized?
We would have to have a talk with your marketing team, as well as with your board of directors, and see what sort of budget you would be able to give. But I think that as much as possible in such a saturated market, you really need to be aggressive and get your name out there. I think train stations and TV stations are kind of the two big areas that you really want to focus on. Get as many people to walk by your name, name recognition, brand recognition, really get you out there. As it is a very affordable solution to many people who may not have very many investments, and they may want to be looking to invest but really have no knowledge. So I really think that getting your name out there, really broadcasting your commission list structure is really the way to go.
Recognizing that you mentioned a couple times when your target demographics is the 55 plus demographic as well, you mentioned a couple times. What associated risk could be, I don't know the Japanese culture at all, are there associated risks with targeting that demographic, considering the online brokerage, discount brokerage model?
That's a very good point. Do they have the wherewithal? Do they have the knowledge of using online brokerage? That would be something that would be a concern. However, as we noted in our presentation, that the bulk of the people are from within 25 to 54. That's 38% of the market, and which is a really important part of the market. And that would be the biggest part that we would be targeting. 54 and above, those people would be in the more low-risk fund that you have, and that would be not your primary market. Your primary market would be those younger people that are willing to invest more, have more years in investing, and as the market grows, then you will make more money from them as well. And in order to help the older demographic, we would hope that we would target them in some type of marketing, maybe some type of having family and friends, and that helping them learn about our platform.
Yeah, and I think one of the biggest issues with that is also with like let's say 45 to 55, it's probably marketing it. What our goal mainly is to get it through an online platform. And that older demographic may not have as much use with like technology, let's say. So yeah, that's one of the risks in actually getting the product out to them in marketing terms.